Hi, uh, welcome back to the chapter number 2, lecture 2. As we have discussed about the law attraction and the dangers of the trading in the beginning, then we discussed about the psychological appeal of the trading. We said that trading promises three things. Number one, independency is give you freedom of choice. You can, whenever you want to enter, you can enter, and whenever you are exit from the market, freely you can exit. The second one, mastery. Uh, if you are following a strategy of yours consistently, you will be uh, expert in that, and that will help you out to do more and to operate in the market effectively. And that another thing that is limitless opportunities. Trading provides you with limitless opportunities. It has a lots of opportunities for you in the market if you have mentally alert, sharp, focused. The second one, that's about attraction lies. We discussed about the attraction of the market lies with your personal success. It means the more you have control on yourself, the more the market uh, you will not be affected by the market. But trading needs first personal, your self improvement is first comes in a trading. The first priority is your self. If you're personally, in fact, personally you are strong, so then you will be able to operate in the market. The last one, however, the same freedom can lead emotional volatility and impulsive behavior. Again, if there is independency, mastery, and opportunities out there, so again, you are coming with your humans, or it has, they always have, they're coming with the behaviors like impulsive behavior. That's is the best of your inner needs. So if you're coming in the market with your inner needs, your desires, so that will definitely affect you, because market volatility will a lot make disturbance in you. So you need to have control on your behavior, your emotions, calm, relaxed, and focused. Now, moving on, the next one we have paradox of freedom. So what does it mean by paradox of freedom? Now, paradox of freedom is, according to dictionary, paradox is something which is seems to have contradictory qualities. It means uh, various qualities of the freedom. Number one, the market impose, the market imposes no external rules. Traders are completely free. It means that no one can stop you, or nothing will affect on you. So it's only you that you are making decisions, only you that you're operating the market. So the decisions is yours, and when you enter the market, it's your decision. When you exit from the market, that's your decision. That's why we say that the trader, you know, the state of mind of the trader is completely free from control. So that's why external factors won't affect you, your emotions. So that's why we can say it's a completely free. Now, we're always saying that this freedom demands strong discipline. Now, that's why we are saying that if you that gives you freedom, but the external market does not affect you, that needs your internal discipline. How much you are, confident on your decisions. If you make a decisions, stick to your decision. If you make any kind of decisions from the market, so you have to stick toward that movement of the market should not be effect on your behavior. So that's why once trader is confident enough, he or she has own trading strategies. Now follow your strategy. Follow your strategy. And every trader has different strategy. If you ask from the traders, so everyone is following different strategies. And some of them, they have developed their own strategy. So you need to be make sure that internal discipline matters a lot. Internal discipline matters a lot. The more you are disciplined, the more you are controlled, the more you will be effective in the market. Now that's why always follow your proven strategy. Once you have proven strategy that yes, I'm making profit with this strategy, while I'm entering into the market, I can see moving average, price index, this is factors. On the basis of that, all your analysis, you are into the market. Now stick toward that rather than following other strategies, somebody else. No, what your observation is important rather than somebody else's observations. Your observation, your own observation is very important. Your own involvement is very important. That's what the trading internal discipline is. Now, then the last one we have, without boundaries. Traders act on emotions and rather than reasons. Now, without boundaries. Boundaries means there should be limitations. There should be limitations. While you are in the market, trading, put limitations that you cannot cross that limit. Whether you are entering the market, where you go to buying a share, you are investing in any shares. So you're observing the market, you are entering the market. Now set up boundaries of that and daily base that, because sometime you made a profit or let's suppose you make a you take out one trade and you make a profit, and you take another trade, you make a profit. But sometime we feel like a greediness, there will be greediness comes out. So make sure that if your target is enough, you fulfill your target. Now close the machine and enjoy that, rather than to see the charts consistently observing and seeing, and changing comes in your emotions. So that's why avoid these things. Now set you know without boundaries. If you don't have any boundaries, any limitations, if you don't have any limitations in your uh, that's why we can say that internal discipline is very in the internal discipline is your boundaries. When you're talking about internal disciplines, that is your boundary. That is what we're talking about, boundaries. If you have no boundaries, so definitely what will happen? You will act on emotions. Emotion means, so definitely you make a decision on the basis of, all the time we can say, be a realistic, like make objective decisions rather than subjective decisions. That you know what you are going to do, you know what you are taking the risk. Like sometimes we are making decisions which is based on our emotions. We feel what we feel, doesn't matter what it feel. It doesn't, your feeling does not control the market. Yeah, your feeling, you need to control your own feelings. Leave the market is doing their own. So now you have to control your own feelings. That's why we're saying that traders act on emotions rather than on reasons. If you don't have a boundaries, you will be emotional. Like in emotional becomes comes out like a fear comes. Now angerness, frustrations, anxiety, disappointment. When you get lost for some time, if you make a trade and your trade goes towards loss, so definitely emotions will comes out, feelings, frustrations. So now from winning trade, you convert it to the losing trade. Now that's up to you. Control your emotions. The more you control your emotions, the more you will be able to operate in the market. Now that's why we are saying that internal discipline is very important. Now next one, that is about the market The market's neutral nature. Now, the market is neutral nature. Neutral means impartial. Is a neutral nature. So the market, we can say that the market is impartial. It has no intention, no emotions. Human beings have emotions. It doesn't mean that a market cannot operate on the basis of your emotions, your feelings, what you think. That doesn't mean that the market will operate like this. Because that's why we can say that market is, it is like a market is won't move according to individual. It will not move according to the individual feelings. It will not move according to individual feelings about their, you know. So that's why you can say a market is impartial. It has no intention, no emotions. That you cannot control the market. Market cannot be controlled by any single person. So that's why we can say it is a collective human behavior, not a fairness. Got it? Now it is, market reflects on the base of the collective behavior or rather than on individual behavior. Well, traders often trader often personalize the outcome, leading to emotional reactions. Now, if you are coming to the market and invest in the market and you believe, okay, I'm gonna win, my trade gonna be profitable. Now, so there is no assurity or assurance that your trade will be profitable because market always move not according to your expectation and desires. So definitely, so you need to control your emotions. It cannot react according to your personal outcomes. What you think it should be like this. No. See, observe the market. No, I say do not operate inside the market on your base of emotions. When you come into the market, do not look to the emotions. What you feel, put you aside. Come with the statistical, come with the constructive decisions. See the niche, see, look the market, where the market position is, what's going on with the market, how people feel. Now, see, when you act collectively, when you understand the nature of as a whole nature, when you understand as a whole nature of the market, then you understand, then you can move. Then you will move that. Otherwise, you will not be able to move. Because that's why we can say market is not for an individual person, or it's not personalized. You cannot personalize the outcome of the market. Illusion of control. Now, illusion, what does it mean by illusion? Why we can call this illusion of control? You know, just make understand the illusion with the when you are winning, when you are winning strikes, ex, when you are winning strikes goes excessively, and you think you did it, and sometimes it might be luck, not your strategy. You know, like that's a kind of illusions. Like you're winning, you're making profit. Sometimes, yeah, great. Sometimes, so sometimes it might be your luck, right? Now that's a problem creates where when you become a success, but that success create the overconfidence, and that overconfidence convert to false sense of control. And then you believe, and sometimes you believe that you crack the secret. Now how to make profit, you crack it, and you become overconfident on that. Now that's why we can say that. So overconfident always, like it affect you and put you in a negative side. So control yourself in such situation. When you're making profit, don't ignore your strategy. When you're making profit, don't ignore the strategy. As like, see, when you're making profit on one strategy and we are following our strategy and we are making profit, and that's well and good. Sometimes we are not following our strategy and we think, oh, now I can do anything. So some, yeah, one, two, like, yeah, sometimes one trade, two trade, then you will be lucky and that luck works, but not all the time. So follow your strategies. Follow the strategy that's proven strategy, the proven strategy that which works for you. Now traders make mistake luck for skill and take excessive risk. Now when traders mistake luck, when the traders mistake luck for a skill and take a excessive risk. And that's why we say too much believe on your luck rather than a technique. We can say that when you believe on your too much on your luck rather than on your technique on risk, and you are taking a excessive risk, high risk, not managing your risk, and you're taking, like, that's why we are saying do not take the trade like for granted. Always come into the market with appropriate evaluation, observation, see where the market goes, then properly enter, and with stop loss, managing your risk. Now the true control, again we said that the true control exists only your one's own behavior, not in the market. Individual cannot control the market. You can only control yourself. Control yourself, you will win in the market. If you have no control in yourself, you are emotionless, so you will not be able to operate in the market effectively. Next, emotional roller coaster. Now see, emotional roller coaster. Now, when you have no control on your emotional, what will happen? So then will becomes emotional roller coaster. Ups and down, loss of expressions, feelings will comes out in all the day. Sometimes sad, sometimes when you earn profit, you become happy. When the price goes down, you become when you are going to depression. When you are going in a depression. So that's why we can say that control. Traders experience a cycle of euphoria. Euphoria means too much excitement, happiness, fear, and frustrations. Now that's why we need to control these things, your happiness and fear and frustrations. Why these are coming? When you are entering in the market with the expectations. When you're entering the market with the expectations, with your internal desires, with your wishes, without a loss of you know ambitions, that what you will do, or lots of thoughts of quick conversion, so that it always leads toward the frustrations. Now that's why when you are winning, so again the saying, so you need to control yourself in both situations. When you lose, control. When you win, control. If you make a profit, the profit, whatever the market gives you the profit, take it and get ready for the next opportunity, because that's why you can say it, market has a limitless opportunity. It doesn't mean that you earn profit now and next you're not able to earn the profit again. You will not be able to earn the profit again. No, this doesn't mean like this. You will earn the profit again, but you need to control yourself. Overconfidence, don't go with the overconfidence. When breeds the overconfidence, losses trigger hesitations or revenge trading. When when you lose one, For example, you put one trade, loss, second trade, loss, third trade, loss. Now switch off or just think about the day is not good for you. That's it. When you win, one, two, three, you make a profit. Now that's it, finished. So limit, set the target for a day, whether you lose or win, set a target. So otherwise you will not be, you know, accept it. When we, if you don't want to frustrate, if you don't want this frustration, fairness in your life, accept your losses, accept the risk, because entering the market, entering in the trading market is a risky, and that is a risky, and you are there to accept the risk, and the traders are risk taker. Let's accept this thing. Once you accepted that yes, I'm a risk taker, I can risk my I'm when I'm into the in the market, so I'm risking. So you're risking your money. You're risking it now. So once you're risking it, so we accept the risk. And once you accept it, then you love, then you feel, then you won't feel that you have losses. That's it. Okay, loss, no worries. That loss will teach you something. You will learn from your losses because your attitude will be in a learning attitude rather than for, you know, a quick turnover. No, don't go with a quick turnover. Always go with the learning attitudes. Your learning attitude matters a lot. Emotional attachment to the result of this, distorts perception and judgment. Oh, lots of things that happens. Emotional attachment with the results. Once the result, the outcome does not come according to your perspective, then you feel again frustration, anxiety, depressions. So if you are a patient of depression, so don't come to the trading market because that's not your place. So be if you have control on your emotions, feelings, calm. So trading market is teach you a lot of things, give you a lot of calmness, give you a lot of, it make you too much calm that you feel nothing's happening in this world. You will be relaxed, calm, but makes you calm. Once you become calm, then you will operate in the market. Next, the danger of random reinforcement. Now see, the first one, random success reinforce poor habits. How random success? How? Because random success is based on your luck. When you too much, when you are too much confident on your luck and you ignoring your strategies and you just entering the market without anything, not just ignoring all your strategies, everything, whatever you have, you're ignoring and you're just depending on your luck. But that's again, so what will happen? Reinforce the poor your habit. Again, there will be a gap between your learning and your success. Because one time you will be lucky, second time you will be lucky, but this doesn't mean that all time you will be lucky because doesn't market does not operate on the basis of your luck. So be realistic. Observe the market, into the market. Yes, luck is there, but you need to have a realistic observation. Do not wholly depend on your luck. Next one, winning from rule breaking and encouraging recklessness. Again, we say that uh, I'll give you an example with the like when the people feeling that trading is a like a gambling. Now let's suppose you put your all money in a gambling. We can say that you put your whole money on a black jack, and luckily you won that. and it doesn't mean that all the time you will be lucky, all the time you will win. And next again you put whole your saving again for earning more. So what will happen again? And you will not be lucky. And that's what you're breaking the rules of your. That's why you in the market, don't act the market as a gambling. It is like it's a proper strategies, proper learning, proper observation. See all the market in there is like there is indicators, there is like candlesticks. You need to understand the candles, the the histogram, the bar, everything you need to understand. You need to read it and observe it and see moving average. Observe every different candles, different indicators that which every indicators has own uh, properties, and understand those properties and act according to that. The last one we have consistency. The traits as a trader confuse luck with the skill. Now, when people make luck for a skill, now what happened that their consistency will disappear. Now, don't depend too much on luck all the time. Skill is important. When you have skill, proper observation, so always skill, understand the skill. See, when you have a skill, you properly evaluate, and then luck will come with you. So then you will be lucky. When you make a profit on the basis of observations, on the basis of your strategy, when you make a profit, then that's you're lucky. Luck follow the strategies, not strategy follow the luck. Anyhow, next, the market is a mirror. It reflects. Market reflects. It reflects. The market reflects the trader's internal beliefs and fears. How you feel, the market react. Like for example, the share price goes up to the point that where a price touch the highest or breaking the top resistance. Whenever there is a top resistance comes out, like the seller enter. Let's suppose one seller enter, a strong seller enter, and he sells some portions of it, and like a strong seller portion of, and a red candle, a full red candle form. Now what do you think that? Now from here it gives a signal to the wholesaler, which only that red candle they see. Maybe sometime it's be like it's make you it's faking, because maybe from here again it goes up. Now what happened in here again when one red candle form? Now a seller become panic, because those people who make a profit, let's suppose they have make a profit, when they see there's a red candle form and their profit comes down to the 20 or 10, like about some points they come down. So now they're scared of what? They're scared of like oh, not losing this profit too. That's why what happened, that panic attack comes and selling starts. That's why we can say it's a reflection of your behavior, how you fear. If you believe that no, doesn't matter, the market will go up, and you stuck yourself and you are seeing okay, this red form is okay, and you keep yourself silent, and you see, because you believe that, because you have studied it, you understand the market, you see the liquidity ratio of it, and everything you have observed, and you believe that no, nothing will gonna happen, because it doesn't mean that everyone comes like you and emotions. This not market does not operate on emotions, because people see as now it's gonna be go up. No. The next candle, skyrocketing. Why? Because those panic buyers, panic sellers, they went out to the market. And again, jump. And again, the same, those who become panic and they are become now panic buyers because they start selling at the top. Why? Because, oh, if you are entering at the top, maybe we are making profit. And the point when they are entering and they believe now it goes up, now the seller, now from here, those people who are early buyer, and they start selling it to make a proper profit from there. Now that's why we can say markets, it reflects the traders' internal beliefs and fears. Understand? Next, every emotional response reveals aspects of one's psychology. Every emotional response reveals aspect of the one's psychology. What you think, how you think, what you believe, that's what the your emotion is, response toward the market. As we earlier studied about the cycle, you know, the roller coaster market, it's the roller coaster. If you are coming to the market with the emotion, with the feelings, so what do you think, what do you expect it? So market will squeeze your expectations, squeeze your internal emotions. Now again, trading is become trading now trading becomes a journey of self-awareness and emotional mastery. That's why we say that trading is a journey of self-awareness. The more you are aware about yourself, about your emotions, about your control, the more you will be operating the market, and the more you have control on your emotions, so that will becomes your emotional mastery. Emotional mastery means whatever happens, whether the price goes up, whether the price goes down, nothing will happen to you. Will not be reflected. That's what we can call emotional mastery. Now, the hidden cost of freedom. Those things that you don't know about the freedom, the hidden cost. Number one, traders seek freedom from the structure but need to self-discipline. And so see, traders seek freedom. You want freedom, but that freedom lies under the who? Under your self-disciplined. And the more you're disciplined regarding the market, you know about your strategy, you know about your entering point, know about yourself emotions, your control on your emotions, you know when to enter, when to exit, how to manage your profit, how to manage your losses too. And that losses which when you're making profit, you're happy, doesn't affect. The important thing is when you make loss, that is important things. Because when you don't have self-discipline, so what will happen? So without internal rules, when you have no rules for your own self, so what will happen? That leads chaos. You don't know what to do. A loss of thoughts will comes out. Then automatically the market opportunity, the gap will disappear. Will be confused. That's why we can say that balance between freedom and responsibility is essential. You need to properly responsible for your every action, every decision. Yeah, that you have freedom. So freedom doesn't mean that you can do anything. Freedom means you have to control yourself. Self-discipline is there. Responsibility for your every actions. You need to take it when you are taking decisions. Be responsible for that, and be responsible that you are a risk taker. Accept this. Once you accept it, everything will be calm. and relax. Transition to the mental framework. Now, again, let's transit it. Transitions to the mental framework. The market does not impose limits. One thing, make it clear for you, all of you, that the market does not impose any limitations. You need to develop your own limits. Like for example, the market operates 24 hours. Now it doesn't mean that you can trade on 24 hours all the day you're sitting. No, limit yourself up to some extent. You make this much profit, that's it. Close it, go home, go switch off and go enjoy your life with your kids, your family, rather than to sit all the day to the there should be a limit on your life rather than to the market. Proper limitations there. Understanding, reading, everything should be there, and proper, like proper time limited for your trading. You're making profit, well and good. 1%, 2%, 3%. Now, whatever the profit that you're making, happy with that. Now, switch off, enjoy your life. The next thing, the focus must shift from the predicting market to manage yourself. Now, stop focus on predicting the market, what's going to happen to the market. Forget about the market. What's going to happen to you? Once you have control your emotions, your behavior, so you can operate in the market. Because market is anything happen with the market, but if you have control on your emotions or yourself, manage yourself is important rather than to predict about the market, what's going to happen to the market. Too much predicting about the market will make you psychological ill. So focus on yourself, and that will help you out to be operating the market. Now again, emotional balance and consistency from the foundation of success. If you have emotional balance and you are consistently following your strategies, so that's the foundation of success. If you have no emotional balance, your emotional list, so what will happen? That ultimately you will be facing problem. Now, the core lesson from this chapter number 2, number 1, trading is trading attractiveness stems from the freedom of an excitement. Number 2, freedom without discipline leads to self-sabotage. It means you need to have self-discipline. If you want to have a freedom, you need to have self-discipline. Then you will be able to enjoying the freedoms. The market is neutral. It reflects, not reacts. It's reflect only the reflections. As I said, market is an individual. No, it's not individual. It's a reflection of a collective behavior, not an individual behavior. A random reinforcement creates psychological confusion. So a random reinforcement. When you have confusion with the luck and skill, so you'll be confused psychologically. Self-control, the last one. Self-control and emotions balance are key to longevity. Now, if you want to success for the long time, if you want to operate it for the long time in the market, so the first thing is that self-control and emotional balance are the key for long-term survival in the market, or operating the market, or enjoying the market. Now, in this chapter number 2, the writer is focusing on too much on discipline, that you need to focus on your discipline. Whatever strategy that you have to stick with that. Stay away, keep your internal feelings out of the trading. Now, if you are a trader, if you want to trade, if you're coming to the trading, so the first thing, you have to keep yourself away from emotions, your feelings, your internal emotions. Then you'll be able to, once you make a profit, enjoy that and move on. But keep your emotions away from the market. The more you are the more you are away from your emotions while you enter the market, the more you will be operating. When you are coming with emotions in the market, that will create a loss of problem for you. Thank you. Thank you so much for your watching chapter number 2, and back to chapter number 3.